Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk this afternoon, we have George Catrambone, head of fixed income at DWS, Lydia Boussour with EY-Parthenon, senior economist, and Nelson Chu, founder and CEO of Percent, to discuss the impact of Fed policy, inflation, and strength of the economy, and what that could look like for equity, fixed income, and credit markets in 2024. It is great to have all of you with us. Thank you for joining us on Trade Talks. And before we get into how this can impact other asset classes, we can't start a conversation unless we talk about the macro, right? What's going on with the economy, Fed outlook. We'll start with you, George, go around the table. Sure. What's been the big focus from your perspective with macro?
Sure, it's been the soft landing. It's been Christmas coming early for the markets. It's been Powell bringing that, and really a market expectation of 6 cuts now, post the Fed dot plot, versus 3, and the 2 converging on each other. I think we've seen some of the data come in. Non-farm payrolls has been like a Rorschach test. I think everyone saw something in there. But the reality is unemployment rate is 3.7%. The economy is still resilient. And as you're looking at leading indicators, yes, there could be a turn, but right now, soft landing seems to be the base case.
Yeah. So Lydia, I guess the question is, are we calling it a soft landing yet?
I mean, in our view, I think a soft landing is also the most likely scenario. There's still some risk as we look at the outlook for this year. There's still some headwinds, but certainly we have seen some encouraging economic dynamics in 2023, and it seems that that momentum is carrying into 2024 when we look at some of the recent data on retail sales, but also just looking at the overall outlook for the consumer as well. We're seeing a lot of resilience, and we think that this year we're going to see sub-trend growth, but the economy should avoid a recession this year.
Yeah, and Nelson, it was interesting for you from a private credit perspective. There was a lot of macro trends in 2023 that really brought private credit to the forefront.
Yeah, absolutely. I think it's a situation where because the macro economy and the general market is so choppy, people are looking to other ways to kind of get liquidity and get capital and things like that. And so when the equity markets were tough, and it continues to remain a little bit challenged, there's a situation where private companies are going to look to private credit to really raise the capital they need to grow. And so you saw private credit grow tremendously in 2023. Anytime there's regulation that comes in, that helps private credit as well. So we're seeing a lot of tailwinds for private credit when it's faster, more flexible, cheaper, and more easier to kind of get a deal done. That'll continue to kind of see it all the way through. And private markets in particular, I think, are seeing, I would say, some issues as well around the IPO market. Mm-hmm. And so that's something that we're keenly watching because I think if the IPO market doesn't open up, you're going to have a lot of downstream challenge with private markets as well.
Did the macro impact, like inflation, Fed, interest rates, did that impact the private credit space at all?
Yeah, it does and it doesn't. So private credit, what's interesting is it's kind of floating rate, right? So when the rates increase, we saw from our perspective and our data, our rates just increased as well because investors saying, I want X premium above the risk-free rate. That's the way they look at it. And so what was used to be 12 became like 15. What used to be 15 became 18. And it was like, fine, right? The problem is that has a downstream impact on the underlying borrower, that small business lender, that consumer lender, whatever it may be, where it almost makes it cost prohibitive to do those loans. And the ultimate underlying impact is going to be on that small business, that consumer who wants to kind of raise or get additional capital. And so it is a trickle-down effect that we're going to see probably coming to a head at some point this year.
Yeah, and it's so interesting, George. We were talking about this off camera, but sure. It has been really tough to bet against the consumer. Look at the economic data, and I think that's what the market's struggling with. What's good for the economy is bad for the markets because you're not going to get those rate cuts.
No, for the moment, good is bad and bad is good until bad turns bad. And I think that's where we really need to keep an eye on, credit card delinquencies getting back to pre-pandemic levels. As Nelson had mentioned, actually, small businesses grew exponentially during the pandemic. And I think that we really need to keep an eye on the services side of the economy. We've really seen growth within or labor holding up in 3 main areas: healthcare, travel and leisure, and ultimately government. And you can speak to private payrolls have actually lagged within that context, but it's been the resiliency in those 3 sectors, and I think we need to keep an eye there for where this ultimately turns. We're still at 3.7% headline. We're still far away from the Fed's summary of economic projections, both for last year and this year coming, which tells me there could be a little bit more work to do for the Fed.
It is a question like where the money came from for the consumer though, right? Because like you saw buy now, pay later during Black Friday, 30% increase from Klarna year over year. So it's not their money technically at this point. and also the savings rate being basically depleting their post-pandemic savings, right, at this stage, with credit card usage at all-time highs. Like, there's a lot of tricky things here that need to be navigated to see how resilient the consumer will be, I think, in the coming year.
Sure, and that savings rate was 2x what people forecasted it to be. That's how much stimulus we dumped in this economy.
I'm surprised it lasted this long, honestly. We're not really known to be savers in the US.
And we've got these revisions to the savings rate as well.
Sure.
So it is, but when you look, I think, at the fundamentals for the consumer, as you're saying, we're seeing, these fundamentals shifting, the savings, being depleted. When we look at also those delinquencies on auto loans, but also credit card, we're starting to see some erosion in consumer balance sheets and consumers' financial position. And I think one also very important aspect that we need to keep an eye on is the labor market, which has been the key source of resilience for the consumer and the US economy. And as we move forward, I do think we're going to see more softening and more rebalancing in the labor market. We have, the unemployment rate still pretty low, but when we look at, some other indicators, we look at the job openings, which have declined significantly, retraced, 65% of their post-pandemic surge. We have the quits rate back to pre-pandemic level. We've seen a lot of normalization in the labor market, and job growth also has become more concentrated in those sectors. So I do think that as we move forward, we're going to see more softening in labor market trends. Wage growth also is likely to moderate further, and I think that's going to be one factor that's going to help with the disinflation that we're expecting to see, more of this year.
Yeah. And I'd be curious to know what sectors we're seeing the decline in. I mean, if it's services, it's one thing we know, retail, that model shifting around. But if it continues to grow in healthcare and tech, to your point earlier, it doesn't really change the picture as much. I mean, if you want to work, there's a job available if you're within the right sector, and I think that's part of what's keeping the consumer strong.
Yes, we've come down from 2 to 1 to 1.4 or whatever you have here, a little below, but there still is a job out there right now on a more than a one-to-one basis. So
yeah, and I think, the December jobs report showed that there's no retrenchment in the labor market and in the economy. If you look at, just economic growth overall in the fourth quarter, is tracking above 2%. So we're still growing above trend when we look at the economy, and that's why I think the economy is still on track to see positive growth this year. We're not expecting to see a retrenchment in private sector activity, but some softer momentum as you still have that lagged impact of monetary tightening, in the pipeline, and also some of these headwinds. We have still high prices, which consumers are looking at, still high borrowing costs for both consumers and businesses, and these headwinds are going to be, leading to softer economic momentum.
So did the market overshoot this gift that got at the end of the year with the Fed saying that we're going to start to cut in 2024? And it's not just the equity market. Everything went up. It's
not the market's fault either. Let's be very clear. Powell went from Volcker to Burns, from Jackson Hole to December. So I think that we need to give and pay a little bit of mind to that. I think 6.5 start to be a little excessive. And I don't think the Fed is going to be very cognizant of making a policy mistake or a second one at this point in time. I think you're much more likely to see maybe some sort of tapering within the QT regime in March than potentially actually a cut to start without more data coming in. Look no further than claims today. That was still a pretty good claims number. Okay, and the NFP result or report, you still saw average hourly earnings going up as well. So I think they're going to have to be very cautious. I think the market should be cautious here as well.
I mean, history serves as a guide, right? You don't want to make a mistake that we saw in the late 70s and 80s, and you can't reverse course that quickly.
Core inflation, core CPI is still above the unemployment rate. And there's not a good historical precedent there to cut rates besides in wartime when that trend is there.
So if we drill down into fixed income more specifically, what looks attractive there?
I still like the front end of the curve. You're still inverted. Money market fund levels are still at record sort of levels, which I think is telling us something as well. All-in yields, look attractive, even though spreads are tight. So I certainly like the front end of the curve, and whether you're playing 5s versus 30s Treasury spread, I think there's opportunities still in short duration.
Yeah, and do you think private credit is going to have a year in 2024 as it looked in 2023?
From what we've seen, yeah. I mean, I think most investors, institutional investors have said, I think 63% said they wanted to increase their allocation in private credit, and so that is pretty telling at the end of the day, right? They're not seeing the yields they want in the public markets, and so they're going to private credit to be able to do it. The tenor is also shorter, and so they're going to be able to react more quickly to what goes on in the market, but it is very sector specific as well. And so you are seeing a less interest in consumers, I would say, is probably the thing, because because the general macro trends are going to dictate what they want to invest in as well. And so the usual small business lending, things like that, are still holding up, especially given the growth that you guys mentioned on the small business side. And also reversion to things that are intrinsically safe, right? So you have things like factoring of invoices, litigation finance, things like that that are, I think, underlying core are always going to be around and be successful and will be okay. Even though the yield is lower, they're willing to trade off the return in exchange for less risk in exchange for higher return or more safer return.
Do you think this is a longer term trend with private credit being accessed? Is it more favorable, or companies and consumers and smaller businesses recognizing this relative to going to the traditional route of securing capital?
Yeah, I think, to be frank, like the private credit is nothing more than non-bank lending at the end of the day, right? And so unless the banks want to go back to the way they did things before, you're going to see private credit here to stay. And for better or worse, I think the regulators have made it clear that banks should not do what they were doing before. And so these larger funds that have come out in lieu of those banks are coming to market here and filling a gap that really needs to be served. The banks, though, don't want to be left out, and so they're trying to find ways to wiggle their way into private credit legally, and you're seeing that as well, whether it's through partnering with another asset manager, or whether it's using a different side of their business that's not their normal business that's doing the lending. So I think all in all, those are all really great tailwinds for private credit, and there is no systemic or not as much systemic risk with that because it's all very insulated within these specific silos, and so you're not going to see this massive like daisy chain effect in the event something does go south.
Right. Well, if you have consumer and investor demand, it's not going to go anywhere. If the demand is there,
Exactly.
it's not going to go anywhere. Yeah. So George, when we think about this, what are the risks to the theses that you just laid out here?
I mean, for me, it was super interesting where the VIX was and where volatility gauges were, especially before this little gut check, as I like to call it, in the market. The accumulation of geopolitical risks over the last 18 months has been meaningful. Now, I'm surprised that markets actually traded higher and/or spreads tighter amidst this backdrop, which still grows. And in presidential election years, there's much more belligerence from places like North Korea as well. So when you add all of these up, right, Hamas, Israel, Gaza, Ukraine, Russia, we just saw Pakistan attacking positions within Iran overnight as well. I wonder if that's being adequately priced in, and you always run that risk of I'll call it a gray swan instead of a black swan event, but you certainly risk at least additional volatility or put protection going higher from here.
It's always interesting when you see the equity markets and the VIX and other volatility markets moving in tandem higher at the same time. That always seems to be a decent tell in my book. Right.
Yeah,
like
exactly.
Something is waiting to
Yes,
break.
one of these is gonna be
Right.
come out ahead here. Yeah.
Yeah, but you know what, the market's been climbing a wall of worry for quite some time. I mean, there's a number of geopolitical risk factors that are in there. You know, it's also being widely reported now, and I'm sure we're, what is it, next 10 months that we'll be dealing with a contested election cycle, not only in the US, the UK as well. Now you have the factor with AI, and everyone's reporting on deep fakes and what's real news, what's not real news, and it's hitting everywhere, even on broadcast, not just social media.
Sure. There has been an erosion of trust, as you've seen, or at least a perception of erosion within everything from medical to media to potentially election. And I think that just speaks to the importance of the moment coming up within this election cycle, and the potential volatility from there. I mean, let's not forget as well, Red Sea. Call it between 10 and 15% of trade goes through there, at least 10% of oil, 8% of liquefied natural gas as well. And the Fed has been, well, more helpful to the Fed in the actual interest rate hikes has been supply chains coming back to normal and oil below $80. Let's be very frank about that point. And that's certainly been a very beneficial tailwind. Goods also coming down, where services or parts of services and parts of shelter have not as well, has really been helpful to this narrative. And that's where I'm a little worried about that accumulation of risks in kind of plateauing the progress that they've made on inflation and forcing them to react in a different way, or watching the market react in a different way.
It only takes one thing to kind of set the whole thing off. So you're seeing there's some unsettling things going on that you're seeing.
Particularly what's happening with the trade route, to your point. That's something we have, we're figuring out what it's like for a post-COVID world. We understand there's geopolitical risk, more so than we've seen in quite some time. But the trade routes, I mean, what is that going to do to inflation and the supply chain, to your point earlier?
And oil was incredibly tight, don't forget. I mean, there's been production cuts by OPEC Plus over and over again. And yes, there's some other people or places online with oil, right, that China is buying from Russia or Venezuela or Iran coming back online. But it's still a very tight market. And like I said, that could be counterproductive to the global disinflation story that's needed at this moment of time, right? UK actually higher inflation print last week than what was expected. And I think that could be telling us something at this moment.
But I think on the trade side, like the we are so globalized in nature now than ever before that every country, every major country that is using those shipping routes has an incentive to help solve this problem, basically, more so than ever before. So you're seeing the French Navy go there and like solve their own problems for their own ships. The Indian Navy went in there and helped their ship through. So you're seeing that happen that wasn't really possible probably before. And there's enough reasons to all these countries want to see it work that all the challenges over there, I think, can get resolved fairly quickly.
The problem with that, in my opinion, is you're also seeing a realignment of risks emerging amongst nations. You're right. So it's great to see G8, G10 cooperation, but you're also seeing interests aligned that weren't there before, like North Korea, Iran, Russia.
It feels like we're at socially, politically, culturally, like at this massive inflection point.
Absolutely.
Needing, when I say come back to the center, I'm not talking from a political perspective, but a total realignment. It feels as if like we're at the precipice of this.
There's some factions coming up, sorry. Yeah.
No, in terms of the inflation risk and geopolitical tensions that we're seeing right now, it is a risk that I think is very important to monitor. When it comes to the US inflation outlook, I think you would need to see an escalation or a prolongation of the issue to have a meaningful and visible impact on inflation in the US. And I'd also highlight the fact that, if you look at inflation trends in the US, we still see a lot of these inflationary forces at play. We have, that labor market rebalancing that's ongoing. We have seen, a lot of that has come from the supply side, which has been a surprise. I think, entering 2023, there were a lot of expectations that the rebalancing would come from the demand side. But we've got some help from the supply side. But you also got, a lot of these inflationary in the pipeline on the rent side. And that should also help push down inflation. And then you also still have some, tight monetary policy acting in the background to slow down that, economic activity. So we do think that, there's, potential for more disinflation this year. We think that by the end of this year, inflation is going to be closer to the 2% target.
Yeah, and I think consumers are, I wouldn't say used to these prices, but understanding we're not going to go back to pre-COVID levels. I mean, technically, if inflation, the rate is 0% year over year, you have to look at it from like 2019 to where we are in 2024. Things still feel very expensive to me.
It does.
I mean, never mind gas. We kind of all understand that, but even just like you go to the food store and you have no idea what you just bought, and you're spending 120 bucks. It doesn't feel like it's gotten any better, even though disinflation is part of the vernacular now.
I think one important point and one important aspect of that resilience of the consumer is the fact that wage growth has been outpacing inflation for the past few months. And that has kind of helped the consumer recovering some ground in terms of purchasing power. And so when looking at the outlook, I think it's a mix of headwinds, tailwinds. On the tailwind side, you still have this outlook of, yes, wage growth is going to moderate, but it's still going to slightly outpace inflation. And that means that, you can still see positive income growth momentum, and that should keep, consumer spending on track.
And I think that's where the Fed got in trouble by using that word transitory, right? Wages are not going to be transitory. You're not going to make 15 bucks an hour and then take back $2 and you're only making 13 bucks. And I think that's where they got in trouble.
But they also have to guard against entrenchment as well. My mom still calls and talks about what loaf of bread and milk costs versus what it did. So there's always, we're not going to go back to the 70s or the 80s or 90s. So there's that trend of both growth and inflation, and that's part of that is healthy. I think we have to be careful where it starts to become entrenched in that last, call it, 1.5% or 0.5% to get back to target will really be interesting to me. And if they can actually get that back to there, or if the goalpost moves a little bit. All right, got a couple more minutes to go here. Let's go around the table. Wrap up 2024 outlook.
Yeah, I think overall, election years always choppy years, right? I think the tell for me personally, at least, is going to be, let's see how the IPO market does in 2024, especially towards the tail end of the year. I think there was like 200 IPOs in total in 23 and less than 30 in the US, and they all did really not great. And so the only way that we're going to see real liquidity in the economy, and especially on the private side, is if the IPO market comes back and opens up again. It'll trickle down into venture, it'll trickle down into all these other things that can happen. You'll see, I think, technology growth again outside of just the sectors that are hot right now, like AI. And so we're looking forward to seeing if that actually comes through, and if it does, that's an overall sign that the market, people are feeling the market is healthy and on its way to being back to the way it was.
I mean, 2024 is going to be a year where we're going to see slower growth, but no recession in our baseline. We think that consumer and businesses are going to be spending more cautiously. That's going to lead to that below trend growth, and inflation also is going to be coming back down. We're going to see more disinflation. That's going to allow the Fed to start that easing cycle. We are not, we're not expecting as many rate cuts as markets, but we do expect to see 100 basis points of rate cut by the Fed. And essentially having this environment where the labor market has rebalanced, we got inflation back towards the 2% target, and just a more balanced and healthier growth as we head into 2025.
All right, and George.
U.S. exceptionalism is a great thing, and I think that base case has been that soft landing, but on balance of risk and go forward, there are risks to ultimately the plane landing safely. So I would caution or urge the market to be cautious here, at least the first half of the year, and then look for a rebound in the second half.
All right, appreciate the insight. As always, thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.